All right, welcome everyone. Welcome to the trade findings and adjustments for May 11th, 2021. It is Tuesday evening. My name is Kevin Hurley. All right, I had four thoughts that came to me. And first of all, some people of you understand this, maybe some of you don't, but every day I look at groups traded, I look groups of portfolios and individual portfolios. And basically what I'm doing is I look at a group. I'm usually starting off with Coda. So I'm usually starting off with Coda. And I just do some simple math as we're going through the day. For today, he was down 22,957, doing pretty good after hours, making up about $1,200. But I just take that 22,957, divide it by 5240, roughly what it would be or what it was. I see 23,163 divided by 5240,000. Key was down 0.44% today and a 0.87. He basically beat the market by what, 40, a half a percent, 0.43. He's doing great. He's in great shape. I like where those portfolios are at. We then go to No Parker. No Parker was down 73,267 divided by 17,850 is basically where it would have been. I was down 0.41. I was able to beat the market by 0.46% today. I like where we're at. Then I do the other non-student accounts. We were down 74855 divided by 16. 250 is roughly where we would have been. Down 0.46. So my first review is looking at the groups. And then I go to individual portfolios. And the key catch here, when I look at individual portfolios, I see if they are within a 0.5% of the S&P 500. Now, obviously, they're not always that way, right? There's some days when we're way above. There's some days when we're way below. What are those days, or what causes those days when I might be way above or way below where the S&P 500 is? Rich says protection. I was not thinking that, but you are 100% correct. Protection is what gave us that almost 0.5% today. Great answer. And Mary, you followed up right behind Rich. Earnings, correct. Because we're more stock heavy versus just blindly picking an S&P 500 or a mutual fund, because we're stock heavy in stocks that should outpace the market or double in a 2-year period of time, we have earnings, and earnings move us one way or the other. Sometimes good earnings move us way above. Sometimes bad earnings can move us way below. So there's another one. A volatility, we have planned for it. There's another great answer by Jim. When volatility comes up, we definitely usually get some protection on, and off we go. I mean, we got protection on today on Under Armour because Under Armour was breaking 23. It did not finish below 23 today, but we have protection back on it, and to a certain degree, we no longer have to worry about Under Armour. Number 3, and this is an interesting one. I hope you'll find as interesting as I did. I do not add protection to leap long call positions usually because it is too darn expensive. And let me just push you through where I'm going with that one. I have shown this to you in the past. And let me bring up the trust account. All right. So in the trust account, which is a high risk, high growth, I have all of these leap calls. I have shares with a protective put. I have some leap bull call positions way out in time. This is primarily a high risk, high reward options portfolio. If I was to try to protect something like Boeing, this costs me $50.81. I'm underwater by about $17. If I was going to protect Boeing, that's currently trading at $228, I would probably get a $30. Of course, you guys want to see what's going on. Thank you for whoever just told me, hey, unmute your screen. Thank you, Abraham. All right, one more time. Boeing, I ended up paying for Boeing $50.80. Currently trading at $33.32. As I just said, I'm down roughly $17. But if I was going to add protection on a stock that currently right now is trading at 128.86, so you'd be looking at that 230 protection, right? Probably going out to June so that I try to stay away from that time decay. If I went out to June 230, right now, that would cost me roughly $11.35. It would cost me over 20% of the value of my leap long call. Sometimes all we're trying to do is make 20% on a leap long call position. If I was wrong and the stock shot up, volatility crush, especially around in earnings, I'd kind of lose everything on this one. I'd be in trouble. I'd actually be in deep trouble. What would I rather do? I would rather save my money and dollar cost average a leap position 1 or 2 times to lower my cost basis by 25% or more than risk 20% of the cost of the option, 20% plus actually, in protection. Does that make sense to you guys? Are there any questions in regards to that? Because that is a question I get quite a bit. But does that make sense why I'd rather spend the money dollar cost averaging, where I can knock the cost basis from 100% of the original cost down to 75, and then from 75 maybe down to somewhere between 50 to 37.50, versus risking 22% of the total value of the position in protection that I'd have to spend or might have to spend for protection on that stock. Makes sense? Are you guys understanding that? If that does make sense to you, type some yeses in there. If you're uncertain, please ask a question. If you just want to blindly trust me, I appreciate that as well. All right. Here's some yeses that are coming in. Perfect. If you do have a a question about it, please type it in. All right. Market analysis changes daily. I love hearing Kramer, the Nigerian brothers, Guy Adami. I mean, there's a bunch of people I listen to primarily on CNBC. I love hearing them trying to make stuff up to understand the market. It's hilarious to me. I don't understand what they're thinking half the time. But what I do know is I'm most likely always going to start with the Dow Jones Industrial Average. I'm going to look where it's at. I'm going to look at the run that it's had. I like to see this chart pattern. I'm going to use a highlighter. Since the start of the year, went up, finished a little down in January, up, finished a little up in February, up with a little pullback, perfect. Loved March. Ooh, kind of ran, but it built a base, and then it ran higher. For the Dow, this is an easy chart for me to follow. I understand this chart. I understand where the markets are going. It looks great to me, easy to follow. I'm in good shape. Nothing wrong with this at all. The S&P 500. It almost mirrors the Dow, right? Start of the year, finished exactly where we ended. Ran up, finished a little higher in February. Dropped down below where we started, made a run up to finish a little higher in March. And then we had a ridiculous run with a great base building. But as I took a look, today we broke our base on the S&P 500. Now the good news is it is a doji, which means we should have an update tomorrow, which would be wonderful because I'd really like to go golfing and I've got a lunch plan for tomorrow. But we're in a period of uncertainty in our stock market. So I'll probably be passing on the golf and I'll probably make it a really quick lunch. But I like the chart we have here until the S&P broke its base today, which means we're probably going to test the 50-day and we could have a pretty significant drop all the way down here to the S2 support level. NASDAQ. Doing a little bit of market research, right? This chart looks like crap. This is a difficult chart. This is a difficult chart to read. Up, bit of a pullback. I like it. Up and finished where we started the month. Up and we broke the 50-day, tried to regain it, broke it again, double bottom, and up to where we started March. Slight profit, right? Our run with a little pullback, our run up, and then we broke the 50-day, and we're down here testing the S2 support level. If we break the 1,352, actually it's 13,052, we'll go down to the 12,439 level. An ugly chart to trade, especially when earnings should have brought you higher. When the numbers don't add up and don't coincide with PE ratios and earnings, we have a sentimental market. We have a market that is not paying attention to fundamentals. We have a market whose VIX throughout the year has been as high as 37.51. Let's put that into plain English for people that googly-eyed and excited to see a VIX chart. A VIX chart is the potential movement of the S&P 500 in the next 30 days. That's the simplest way to understand the VIX. The algorithm is plain and simple. The possible movement of the S&P 500 in the next 30 days. Currently, we're sitting at 21.84. That'd be a huge movement, up or down, for the S&P 500 to move 21.84%. In January, when we had Biden get into office, when we were having, well, I guess when we weren't having, that was after the fact. I was going to say we were having the riots, but that's not true. But basically, getting a Democrat House, Senate, and president caused some uncertainty in the market. To the end of February and in the beginning of March, we're up to 31.16 and 31.90. We have some definite uncertainty. VID, I think, is what we have for the VIX for, what is the VIX for the NASDAQ? Anyone remember off the top of your head the VIX for the NASDAQ? Waiting for Abraham to throw it in here. I thought you'd know it. VXN. The NASDAQ has been even worse. The 30s all the way through December. In January, it hit 40.53, 37.86, finishing today at 27.86. There's a huge amount of volatility in the NASDAQ. This is where we start to speculate, right? This is where let's speculate the reasons why the market has no clue what to do. And I brainstorm. And again, new presidency, right? Uncertainty there. Higher taxes. Higher interest rates. I'm going to just say this politely. Destruction of some industries for the new green bill. Ooh, inflation. And inflation comes with more stimulus that we probably don't need. Just flared up today, right? Potential oil disruption and future wars. We have no clue what's going on, even though we're trying to bring our people back. Another great one, huge public trust and confidence in the government. And I am saying this more because of Biden's health. I'm saying it with it because of Pelosi and Schumer. There's a lot of uncertainty when it comes to our government right now. And unfortunately, I do think Trump, to a certain degree, brought that upon us. But again, if I work my numbers, I'm not sure I trust the voting results either, to be honest with you. COVID recovery. Global COVID recovery. Are we going to recover? Are we going to get back out? You know, if we are, why are we still wearing masks? I really have not been a mask fan. Maud politely put me in my place. She says, well, the next time your dentist is doing your teeth, have them not wear a mask. I was like, all right, I get your point. Ouch. An unusual pandemic is all I'm going to say. Oh, Maud said surgeon. I think I'd be more comfortable with the surgeon not wearing a mask than my dentist. We had, let's see what else we have here. we had a bunch that came in. EV health robots. Education is going to become garbage for general public. So there's another one. When we talked about recovery, education lost in the past year and a half. It's hurt my kids. Concept of democracy, freedom, even regimes by force are not what they used to be. I like it. But look at what we came up with for this uncertainty, right? We've created plenty of reasons to not see continued growth in our market. This person's not here, but yesterday I gave the comment that, hey, S&P is up. Hurley Investments as of right now is not beating it, but we're going to look at it for the year. This individual was so certain that we would have to redo the way that we're doing things with Hurley Investments. And I politely told him, not going to happen. The only thing that we might redo is managing your money. But Kevin, the S&P is up 13%. It was really easy to say, so since you want to make this a bet, let's bet your portfolio against mine that the S&P will not be up 13% by the end of the year. And this very individual very quickly backtracked. And I was like, no. You think it's going to be 13% or higher? We don't have to worry about it falling down. We got all the stimulus money coming in. Let's make it a $250,000 bet. My IRA for your joint account. Let's put it in writing. Let's have the lawyer sign off on it. Let's go for it. Well, that would be stupid because there's a lot that can happen and a lot can change. And it was like, bingo, you said it, not me. In all reality, I'm shocked. I was going to expect probably a 10 to 13% down market. I still think we'll probably end the year that way because they're looking to raise taxes. September, October will be the sell-off of sell-offs. Those are usually the two worst months in the market. And for all intents and purposes, we're going to have 2 years of some much higher taxes that are going to be wasted. And the sad part is these taxes that we're paying is really just to cover the interest on all the money we're going to shell out in the next, the next 4 to 6 months. It's very difficult to invest in the stock market. Just going to put that in here. It's even harder to see where the market may go when you limit yourself to a single day, week, month, or quarter. A couple of my favorite sayings. The stock market is not an ATM machine. The stock market returns are and have never been linear. Averages are not your friends. Protecting to the downside is the key to beating the market. These little sayings, these little things that keep coming up are experiences that I have had when it comes to the stock market over the entirety of my life. It's not just something I've read on the internet. It's not just something that I've seen or done in passing. This is the key to having these understandings and having these experiences that have made me into the financial manager that I am. I don't have you guys pay me $2,500 to $3,500 for a number, for a financial plan, excuse me. There has never been a financial plan that has ever worked because they're giving you linear results on a volatile market. Let me say that one more time. There has never been a financial plan that has ever worked because they give you linear results. Actually, I said a linear plan on variable results. You want to know how I judge financial planners and financial money managers? If they give out a financial plan and have charged you for it, I know they don't know a damn thing about what they're doing in the stock market. They're just drinking the Kool-Aid. Guys, I just wanted to talk with you about the market and what we're doing. I just want to give you an understanding of everything we have that could be coming up that'll move the market. There's a lot on the table this year. Once again, it's kind of a unique market, but that doesn't mean we can't navigate our way through it. We will probably have our results come the last 4 months of the year where we handily beat the S&P 500. But right now, with everything that's out there, worry about staying afloat. Worry about being protected or even overprotected in case the bottom drops out. Look and pay attention to each one of these reasons on what could cause our market to go lower. And spend some time studying and reading about it. Spend some time understanding it so it won't quite catch you off guard. Great comment. The plans also divest you on something that weakens your chance of recovering or winning the market by having bonds. That's a great one. In fact, it's funny that someone just mentioned this. A 60-40, here's the keyword, asset allocation model rarely beats the S&P 500. Even in down years, the S&P has to lose about 10% until you will handedly, or until you will beat the S&P 500, and that asset allocation. Great point. Any questions you guys would like to ask me tonight? Most likely Key will be taking Thursday. I would not be placing any new trades. I would actually be adding more protection on anything right now. We have Disney coming up. Disney, we will most likely be rolling the 190 protection for a small profit down to an at the money. If we were to look at Disney right now, well, we got 185s. Might be moving the 185s down to 182.50s. Same thing, we get another update on Baidu, bouncing off a support level. We will probably move the, what would we move? The 215s that are on the stock. All these 215s will move on down to 190-ish. Try to get it to at the money. All right, let's see. We had a couple questions that came in. December 18th. I don't know what December 18th is. Please let me know. It should be the 18th of May for Baidu. How reliable do you think the pivot points are in the charts? Abraham, the pivot points are very reliable when it comes to those smaller movements. And that pivot points is just herd mentality that has helped me out to better understand where option trades can go over a 30-day period of time. I don't pay a whole lot of attention to the support resistance levels and act as if they're going to really bounce up and down off them. But that does give me a general idea where it takes one standard deviation and it divides it up into smaller pieces with that herd mentality that truly gives you an understanding of a stock movement within a week, or excuse me, within a month. If we can, let's try to bring one up for, let's use Disney, because Disney's been one I've been paying attention to here. Well, it used to be right here. There we go. And I do use a Williams percent R. Used that one for decades. When you've looked at Disney, it gives me at least a better understanding of where it's moving for that month. Came down, tested the pivot point, down below, couldn't break above. Tested it, couldn't break above. Came all the way down and tested the pivot point at the support level, bounced higher. Look at Disney running right in between the center pivot point and the S1. A great example of understanding and using the pivot points to see Disney move. Let me also give you the one on Baidu, because I've also been paying attention to Baidu since it's been falling through the roof. As Baidu was falling, I was looking at levels of support to take protection on and off. I paid a lot of attention to the R2 resistance level, and it tried. When it didn't hold it, pretty easy to judge your next level down. And this is where we made a decision, we're going to keep it on, bounced it up. And man, when it hit 74 in that day, which was the last day for that option on Friday, we were trying to take off all of the protection. As soon as it hit there and bounced higher, we were taking off everything, but we couldn't get it till it was like 177 to 183. Finished all the way up at 190 almost. Pretty important. I was thinking, okay, we might be building a base, but it actually just stayed all along the pivot points, and very disappointed not to see any pivot points hold. And now testing the 200-day simple moving average. That's why I said it wouldn't surprise me if we add a second set of protection on for Baidu on the share count. If we break the 200, we could go all the way down to 132. Today was a very important day to see where it ended up at. Great questions. Are there any other questions you guys have for me? If not, guys, have a wonderful evening. I appreciate you being here. I hope this helps you better understand the mindset of what we're looking at and what we're doing. Thank you very much, Abraham. I hope this also helps you understand where we spend our time during the day. We actually have a bigger list. I think we've got 28 or 29. Oh no, what can make our market go down? Where are we seeing problems that Keith and I are daily trying to find all kinds of answers for? New presidency, hard tax 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. We have 14 of the 28 or 29 that I'm sure we have on our list, just to do the research so that it won't catch us off guard, just to see if there's some things that we can plan for ahead of time. This is what we do. We dig our nose into anything we can find on higher taxes, on higher interest rates, so that we get an idea of what we can expect, where the Fed might move interest rates, what new stimulus might come out. It's just our way of trying to make sure that we have all the information that we need to make our best educated decision. Have a great evening. I appreciate you attending. Look forward to having Keith on Thursday, and I'll see you guys next Monday night. Good night.